Hey everyone, welcome to Alpha Insights. I'm Brittany. Quick note before we dive in. US markets are closed for Memorial Day, so no trading updates from today. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
And I'm Mark. Good to be with you. We'll walk through how inflation affects different sectors and what to watch heading into the long weekend.
All right, let's get into it. At a high level, there are three channels that connect inflation to stock prices: rising input costs, central bank rate responses, and how higher yields change the discounting of future cash flows.
Exactly. So the first one, input costs, is pretty straightforward. When commodity prices or wages pop, companies that can't raise prices fast enough see margins squeezed.
Right. And the second channel is policy. If central banks tighten faster than expected, borrowing costs go up, and that hits leveraged businesses and capital spending plans.
And third, valuation discounting, which is the quiet one that really matters for growth stocks. Higher nominal yields push up the discount rate, and that whacks companies whose earnings live far in the future.
A quick way to think about winners: sectors with pricing power, exposure to commodities, or shorter cash flow horizons often do better. Losers are those with long-duration cash flows, heavy leverage, or weak pricing power.
So who tends to win? Energy and materials often benefit if inflation comes from commodity moves. Higher oil or metal prices can flow straight to producers' revenues and cash flow.
Industrials and other cyclicals with short contract horizons can also pass through costs on new work, especially if they have backlog or indexation clauses. And select consumer staples, the big branded names, can raise prices without losing customers. On the flip side, growth tech and communication services are vulnerable because their value depends on earnings far in the future. Higher discount rates hit them harder.
REITs and utilities also get squeezed. They're capital intensive and often use a lot of debt, so higher yields make dividend streams less attractive and refinancing more costly.
Right, and consumer discretionary can feel the pinch if inflation erodes household purchasing power. People delay big purchases when financing costs climb.
Let's pause and give listeners a practical framework. Analysts often look at three things: pricing power, margin exposure, and duration plus leverage.
Pricing power is: can the company raise prices without losing volume? Margin exposure is whether costs are variable or fixed. Duration and leverage is about where the cash flows sit in time and how much debt the company carries.
Exactly. A company with strong pricing power and low net debt usually weathers inflation better than a high-growth firm with stretched valuation and lots of leverage.
Let me give a simple valuation example to make duration tangible. Imagine a firm delivers $1,000 in free cash flow 10 years from now. The present value at a 5% discount rate is about $613.90. If the discount rate rises to 7%, that present value drops to about $508.30, roughly a 17% hit just from a 2 percentage point move in rates.
That math makes it clear why long-duration names take a beating when rates rise. I mean, when you look at the data, a lot of value sits in later years for high-growth firms.
A real-world comparison helps. Think about a large consumer tech company with strong brand power versus a big integrated oil company. The tech firm has pricing power, sure, but much of its value is tied to future growth, so higher yields can trim its multiple. The oil company benefits directly from higher commodity prices, so rising inflation tied to energy can actually boost its cash flows.
Right, but a big caveat. It's not just nominal inflation that matters. It's real rates. Real rate equals nominal yield minus expected inflation. If nominal yields move in step with inflation expectations, real rates might not change much, and equities could be less reactive.
Good point. Also, market surprises matter. Inflation above or below expectations drives bigger repricing than a steady, telegraphed move.
Quick reactions. Interesting.
Right.
Some common mistakes to avoid. Assuming every stock in a sector behaves the same. Intra-sector dispersion is huge. And chasing last quarter's winners without checking fundamentals and balance sheets.
Also, don't confuse nominal inflation with real yields. And don't forget demand effects. Higher prices can reduce demand for discretionary goods, even if input costs fall later.
To wrap up, here are the key takeaways.
1. Inflation transmits through input costs, policy rates, and valuation discounting. Each affects sectors differently.
2. Look for pricing power, margin flexibility, and sensible leverage when assessing stocks. That matters more than sector labels alone.
3. Watch real yields and central bank signals. And remember, surprises drive the biggest market moves. This is informational. Analysts note these factors, but it's not investment advice.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content.
Thanks for listening. Enjoy the long weekend, everyone. And we'll be back with more insights when markets reopen.